Hey everyone, welcome back to another Top 10 Report video with myself, Richard, and of course, Ross Haber. As usual, we'll cover the health and breadth of the market, look at the market indexes, and also cover the stocks on the Top 10 Report. So with that, Ross, I'll hand it over to you, and let's start with market insight.
All righty, let's start from the top with the market averages, NASDAQ and S&P 500. We saw day 5 follow-throughs on both major indexes the week before last. Unfortunately, this week we saw 4 out of 5 days down this week, Monday through Thursday. We're all down. The NASDAQ picked up a distribution day on Tuesday. The S&P 500 picked up a distribution day on Tuesday and Thursday. Tuesday was the second day after follow-through, which decreases the chance of that rally really sustaining itself dramatically. So more importantly than the market averages, which are not looking great at this point, is still the health and breadth of the market's leadership. We saw the breadth in the biotech area clearly improve this week. No doubt I'm watching more stocks complete constructive looking right sides as we move up, the right sides of their most current consolidations. However, I'm seeing very few stocks elsewhere. I think I was discussing with Richard earlier, we've got a couple electric car stocks. Unfortunately, they're both in China. Tesla, as we all know, has seen its better days. So the group isn't that big. It's great to see a little bit of relative strength there, but that's not going to be enough with the handful of stocks that are working in that biotech area. Unfortunately, to add to that, running my screens after the close today, I would say in addition to those same biotech stocks that have honestly been coming up for the last few weeks, that area of the market has clearly been strong for a good, 4 or 5, maybe even 6 weeks at this point. It's been standing out. But other than that, I'm looking at Hershey's and Post and Coca-Cola and water utilities. And those are all defensive areas of the market. Those are, the stocks that, and let me add to that, the retail discount, right? So Go Grocery, along with Dollar General and
Dollar Tree, DLTR.
Yeah, those stocks, and I'm forgetting. So there's another.
BJ?
There you go. So, so those are, you could say inflation stocks, right? People are going to the cheaper stores to try and save money with the big boost in fuel and food costs. It's also, those are your steady earnings growers. These are the stocks where the big funds that can't run to cash try to hide during prolonged downtrends in the market. It's just kind of what they're forced to do. So to the extent that it passes their, what their fund is supposed to be doing, they're not going outside of what their, fund paperwork says, so to speak. That's where they try to hide out in these stocks that don't move around a lot, that tend to have rather steady earnings, even though it's not huge growth, even when the market's not so hot, right? So until we start to see money moving back out of those areas and, into some traditional areas of growth, I like to see at least 2 or 3 starting to move at a time, preferably 5 or 6 working with, breadth building in, 2 or 3 of the strongest groups, while I've kind of see backup coming behind those. This is another thing I was discussing with Richard today. I want to see a lot of stocks, let's say, forming a bottom, setting up in general. Some will do it first, some will be behind, but that I like to see what I've noticed in the beginning of most, after a prolonged downtrend at the beginning of a new big uptrend, we're going to tend to see a lot of those launching pad patterns that Richard and I talk about so often, where we've seen all of the stocks moving averages curve around the bottom with the stock, however it bottoms, and start to converge to the upside in a tight bunch. The leaders will tend to do, the best leaders will tend to do this before the market, right? So as I'm keeping track of the market daily, and this can be done weekly, that's what I'm looking for. As I'm keeping track of my stocks, as I keep my stocks in my watch list in groups. So everything medical, healthcare, biotech, I keep over here. Everything technology related, I keep over here, and everything else, whether it be specialty retail or whatever outside of those two, I keep over here, just for a general division in my mind that I like to see. Growth, my growth stocks show up in those areas. So in my brain, as I'm doing that, I start, it's another way. So there's one way to look at industry group strength, right? You could use IBD or MarketSmith and just straight up look at their rankings. They're fantastic. They show you 197 industry groups, 1 through 197, where they are on a weekly basis, also where they were 3 months ago and 6 months ago. So you can pick up those. So if you might not be, let's say you're coming up off the bottom, but might not hit a screen because you're still in the lower half of the overall industry group, you can still see which groups are starting to show strength that were weak. Mm-hmm. I tend to do it the other way. I'm constantly running screens on the market. I tend to let the individual stocks guide me, because as I'm, filling out my watch list, healthcare here, technology here, everything else over there, I'm seeing the buildup. Even, when I, for my watch lists are built up that way. So before I even, begin this report, I already know where the strength is, and whether it's where I want to see it and what stage are these stocks in? Are they in early stages? Does the group have the potential to build? And ultimately, what are we looking for here? We need to see enough traditional growth leadership to sustain a new uptrend in the market. We don't want to see, this mediocre stuff. Oh, there's a few stocks working, and yes, I could, at this point, we want to be late to the party, if anything, not early. Early in these bottoms as they form tends to get you chopped up more than anything else. A, because you never know if the bottom's completely in, and B, unless we just have a V-shaped rip at some point from where we are, a lot of markets that end with a deep prolonged correction will not necessarily rebound and favor your methodology super quickly. It tends to take a little bit of time, and during that time, you'd be surprised how much money you can lose getting chopped up before the market begins to cooperate with you. So also remember, there's a big difference between the bottom of the market and when the market puts in the bottom and when it actually cooperates with you. It can be months, and you'd be surprised how frustrated you can make yourself and how much money you can chip off the top while you're waiting for the actual, follow through to happen. So I can't stress enough, be late, not early. Okay. So now let's move on to the indexes that I'm done blabbing there. So looking at the NASDAQ composite first, we can see here, as we said, Monday through Thursday of last week, we sold off. Fortunately, we have not undercut the ultimate low of the rally. That's what keeps the rally still intact, although under heavy pressure. And you can see volume was there on the way down. We didn't see a whole lot today as the market bounced. Yes, we haven't made new lows, and we closed above this low, but listen, we're below its 10-day moving average and everything else, and there's no shortage of resistance for the market to push through here. So again, even if we had 10% of the genetics, biotech and genetics stocks looking fantastic, and my guess is we have less than that and a handful of other names, that is not what, to me, from if you want, just from my experience, what I've seen, that is not going to be enough to sustain the kind of uptrend we're looking for to ensue after the damage we've seen and how long it took to get here. We could see a V-shaped bottom. The leaders are going to let you know. You don't have to guess. Don't worry about it. Just wait. Remember, it's one of my favorite things that Scott O'Neill constantly used to hammer home when he would be out there doing videos, is remember, we're not here to predict the market. We're here to interpret the market. And once you get that down, and really figure out how to interpret the leaders and understand what leadership looks like when the market's strong versus when it's not, and you start, you know, with experience and through market cycles, you get a feel for where that line is, so to speak, right? And, you know, this is the art of the market. You know, I think Stan Weinstein says it beautifully in his book. You know, it's like an artist picking up his paintbrush for the first time. You're not going to knock out a Picasso your first try, but with some, you know, time and practice, you'd be surprised. You can really build a, you know, that basic skill, even if you don't become a Picasso. And in this case, wind up saving yourself. You can't imagine how much money and how much aggravation, right? That mental, emotional capital. So for now, yes, we've still got a rally attempt intact, but you know, we've got hit with immediate distribution on both averages, only one on the NASDAQ, two on the S&P 500, and more importantly, the leadership's just not there yet. So moving on to the Russell 2000 here, I see we got a little space in between that needs to be fixed. We're looking at the same thing here. Small cap index followed S&P and NASDAQ last week. Oops, let's get the volume up on there. Sold off 4 days straight. Took a little bounce on Thursday, right? We had a reversal, closed higher, followed through yesterday. But again, volume was lighter on Friday. So we got a little bit above the 10-day here. That's about as much as you can say relative to the NASDAQ. And was the S&P 500 above? No. So yes, the S&P and Russell closed above. And again, keep in mind, this is the IWM, not the actual Russell index, but looking on here, you know, so the NASDAQ closed below. The Dow, same thing. It was weak last week. You know, if you want to say which one showed the most relative strength, I mean, yes, it was the Dow showed the most relative strength. We actually had an up day here instead of, you know, so we were up 2 days last week. But at the end of the day, it doesn't look any better than the S&P 500. And I mean, only on the surface if you're really trying to make yourself feel better about the shape that it's in. And it's not good shape. None of the indexes are in great shape. So moving on to the top 10 stocks. I think this one is a follow-up from last week. GTLB actually pushed through here, but you'll see volume didn't pick up from the day before. It wasn't necessarily big. So it wound up failing anyway. That isn't a buy that we would typically take even in a strong market. Fortunately, relative strength has, you know, stayed up and is continuing to make new highs. These moving averages have converged and are continuing to expand right beneath the price. We're continuing to get support at that 10-day. Even when the market was super weak last week, this is showing incredible strength. So again, I think it's worth, you know, if you wanted to start getting your feet wet, buying on strength through that same pivot, very tight logical stop at the 10-day. You could pick a little bit lower if you wanted. It's up to you. You can pick a little bit lower and scale it. And there's a million ways you can do it. But that, to me, you know, right off the bat is you're very, very tight, logical, and gives you plenty of room. However you want to loosen it or tighten it from there would be, you know, personal choice. CELH is Celsius. I guess it's a soda that's supposed to actually help you lose weight when you drink it, if I'm not mistaken, right? It's a drink. You got a Vast doing its work there. So again, we've seen so we've got the big volume, the highest volume in a very long time here. This is, you know, what I call the Ray volume. We've continued to hold that higher highs, higher lows. This is a wider swinging gap year stock, but the moving averages crossed and have held. We've got another, you know, we started to weaken, but again, the moving averages have turned up and are supporting price right below what we would call a consolidation pivot. This is not your typical textbook based breakout pivot or anywhere near that. So as we're showing all of this constructive action and accumulation, relative strength, even though it is a beverage stock and not my typical growth, you do have some of these specialty drinks like a Monster Energy drink. This falls under that category. So this is worth keeping an eye on. It's got the numbers and all of that stuff. So this kind of, it's defensive and not necessarily so. So that's what we'll say there. H&R Block, amazing. You know, we all know H&R Block from their commercials, largely do tax returns. I know they've got other business as well. You know, it's a big financial company. It's typically a big, slow, boring stock. It doesn't take um, anything. It doesn't take any special skill to see all of the giant volume that's been just pushing this thing on the upside. You can see here, this really came in with the market, but notice the volume on the downside relative to what had been pushing it higher prior. And notice here, I don't know, this looks like, I don't know if it was earnings, but there was something went on here. The volume was huge. And as Stan Weinstein says, you don't want to just see the initial volume. That follow-up volume is very important, and you've got it there. So this is tremendous strength. It managed to hold its short-term averages. So here you've got a chance. And so if you'll notice, I've got 36.83. This price here in stockcharts.com is incorrect. So this is the correct price. So buying it on strength, sell stop at 36 bucks. You've got, as you can see, you've got a little bit of support here at a prior consolidation pivot. You've got a little bit of support, you know, so you can, that's your nice, tight, logical stop. You could also buy it on weakness if you were so inclined and pick a stop, you know, somewhere in and around this prior high or its 10, 21-day moving average, the low of yesterday. All of those places would work, right? So moving on to our next stock, AMGN, big winner from a long time ago. I think Ray actually a super interesting chart of AMGN earlier today. Was it you, Richard, or was it Ray? I think one of you guys.
I think it was Ray.
Anyway,
yeah.
Okay. So if you guys want to check that out from 1990, I think it was. So AMGN, you know, it amazingly enough, there's a lot of these older names like AMGN and some of those older biotech names, or let's even say the larger, like we're seeing a lot of the larger cap biotech names that actually have revenues and earnings act well. So it's not just AMGN. It's, as we'll see as we move down the list tonight, we've got SGEN, which is also another one of those larger cap, legitimate big revenue companies. And then you've got the really big slow ones that aren't necessarily genetic stocks, but are in that same overall sector. Your Bristol Myers, Eli Lilly, MRK.
Yeah.
Johnson & Johnson is probably the slowest, sloppiest of the group, but that's another one. So it's interesting to see these stocks have, been powerful in the past. So when I start to see this, constant push off the bottom, Amgen's been showing relative strength for a while now. We're starting to see that big volume come into it. So I'm watching this one closely. We've had the biggest that highest volume in a long time here. And since then, Amgen, you can see it in the relative strength line, has held up extremely well above its moving averages. Volume has been relatively light as the markets got smushed. So I'd be interested on strength here. And, this is a significant area of support. If you want to, really play that 50-day moving average on a closing basis, if this is going to work, risk reward here is fantastic. And it's definitely in the right group. Not only is it in the, the right group, you've got a lot of those. The theme in that group is for those there is a big cap theme going on in that group, I should say, where it hasn't necessarily been there in the past. So that sticks out in my mind, right? So EVH is another, this is actually medical software stock. So I guess we could have had it a little bit higher, but nevertheless, also related to medical. Nothing new here, massive relative strength. The earnings here are incredible. We've got that launching pad set up with the 200-day right below. We're seeing that massive ramp in volume in a stock that, yes, extremely volatile. So always keep this in mind. You can look to the left. This stock is super whippy. The ranges are extreme. They were here. They were 2 days ago. No one ever minds it when it's higher, but when it's lower, when it does this, everyone wants to know what's wrong. Nothing's wrong. That's how this stock trades. Understand that. So when you get involved in this stock, just make sure you understand what you're getting involved with. And this is where it becomes super important to have your sell stops in place, whether it be an early alert or an actual sell stop in the system. You cannot let a stock like this get away from you. Just assume that it's going to continue to do this until it actually has that character change. And so far, While it has the potential to really explode, I'm not seeing any reason to assume that these wild days have gone anywhere. So keep that in mind. Moving on to HRMY, another biotech stock. This is another one that's a little bit wide and loose, but again, this has been, one of those larger biotech companies that actually makes money. And you can see this group has really been showing strength for quite a while now. This, has maintained that uptrend, all the way back since, what are we looking here? In May, relative to the rest of the market and just about anywhere else. Maybe you had, oil and energy participating for a little while, before they have recently rolled over, but this is the last of what's strong out there other than your defense, a lot of your defensive names, I'll tell you, insurance was another big one showing up with the packaged foods and beverages and everything else, on my screens today. That's another area that, the funds like to hide if they can, right? Those big, slow, steady earners that everyone has, can name. INCY, another biotech name, but fortunately another institutional quality name that actually has revenues and earnings, I believe, at least revenues, if not both. I want to say both. Here we go. We've got a nice launching pad set up in the works. I love when you've got an early consolidation pivot just above that 50 and 65 day, which are nice and tight, and just below, you've got everything else coming below it. Again, while the market was not all that favorable last week, this stock rallied for 3 days. We've got the relative strength line leading it back. So again, you've got a stock exhibiting extreme power. It's in the right group. It's got the earnings. It's got the, that price volume pattern that we're looking for, with the big volume on the upside, nice tight light volume when the stock's coming in and respecting its averages, and you can see here it's nice and tight light volume as it closes here. So it's got, again, we don't have the strongest rally going right now, and we certainly don't have very broad leadership, but again, this is where the strength is. NBIX, another. So this one is a little bit, more risky, I would say, in so much as I don't think it's got the earnings and sales. Maybe it has the sales. However, it does have super institutional sponsorship and everything else going for it, the price volume, the relative strength. And we've seen this stock lead before. So this stock has big potential, and it's another one that, has shown that power over the last week and is giving you, plenty of short-term entry areas that you can try and squeeze your way in, like, assuming the market were to continue from here. Again, don't get too excited if you were to do it. Take very small positions where in my opinion, we're still in that phase of the market where if I were to get my feet wet, it wouldn't be with more than 2 or 3 stocks and a maximum of maybe 3%. So let's say I bought 3 stocks at 3% a piece. I'm in 9%. So if the market isn't done whipping around in a big way and I were to get stuck, I'm not risking a whole lot of my whole account. But you can bet your butt if you're wrong by a couple of days, you'd be surprised, or maybe you wouldn't because you've done it, because I've done it. I'm always amazed at how much money I can lose invested just 10 or 15% in a short amount of time. So keep it tight. It's not, all you can do is laugh when that happens. It happens to everybody, but to the extent that you can avoid it and wait for the, that push, to get to the point where the group you're in, and especially the market, is helping clean up your mistakes. That's where you want to be. SGEN is another one of these larger cap, more liquid names that the institutions prefer. You can see this relative strength line has been screaming by me for quite a long time here. We've had all the moving averages cross here. We're almost getting 2 launching pad setups, right? So we've had it here, hold. You can see this huge move out here through its 200-day, through this pivot, and it hasn't given up an inch. Over the last 2 days, it doesn't even look like it touched its 10-day yesterday. Today's the first time it's touched its 10-day line since we've seen this explosive volume. And we can see here the upside volume has continued to flow in, and the stock's holding up like a champ. So when I see this sort of explosive strength, I think it's, risking a few percent to buy on strength and use its 10-day, or let's say that this prior high or the lows of where, any one of those spots on a closing basis is worth a shot. So if I was going to pick a stock, this is the sort of thing that I'm looking for, that, maybe I'd buy 2 or 3% and see if I can make some progress, and watch to see, can this group continue to broaden? Can we start to see other groups of, that we would consider traditional growth join this area of the market? So that is, I think we've got exactly 10 in the top 10 tonight. And like we've discussed, mostly biotech stocks. So Richard, what have I missed? What can you add for us here tonight?
Nothing too much. I think this is a great group of stocks to watch. Outside of biotech, healthcare, it's a little bit sparse out there. We've seen pockets off the bottom. We've seen China names act well, K-Web type names, LI. We mentioned the electric vehicles, but outside of that, there's not too much. DQ, another China name out there. But I think we pretty much covered here, and given a great overview of the health and
Actually,
breadth of the market. So.
I don't mean to interrupt you, but as you say that, that is one other group along with the electric stocks, but it is again largely China, like Richard just said. We've got, let's not discount the solar stocks. It's not a huge group, and there's 2 or 3 stocks looking there. But what is it? SEDG, DQ,
ENPH,
ENPH. There's 3 or 4 of them up there, and I think 2 of them Chinese.
DQ is for sure. I think the rest are non-Chinese, but yeah, it's a group that's also showing a little bit of something. Yeah.
Yeah. Okay. So anyway, I don't mean to interrupt, but yeah, that's important too. So worth keeping an eye on there. There's absolute strength going on in the solar stocks. I just don't have them on the report tonight, but definitely keep an eye on those. They are on my long watch list, even though they show up nowhere on the report. So I just wanted to stick that in there. Sorry, Richard.
No, perfect. I think we'll leave it there. Thanks so much for watching. If you enjoyed, go ahead and leave a comment down below. We'd love to hear your thoughts as well. And other than that, thanks for watching, and we'll see you guys next week. Take care.